over the last month, the quarter point drop in rates that we saw, that created a 400% increase in applications. That just shows you that people are like, I need to buy, but I can't. Those things come down to low sixes, high fives, something like that. I just think the floodgate's open. It still is a seller's market because we don't have enough supply, and home builders haven't caught up and will likely not catch up anytime soon.
We start at the beginning of the year and they go, hey, we're going to drop interest rates. And it doesn't feel like they have. And so we're trying to figure out okay, when is this thing going to drop? Because my feeling is when interest rates drop, that's going to cause a flood in the marketplace.
Yeah.
When will the market crash? There seems to be a prevailing sentiment among a contingency of consumers that the housing market is about to crash. And when it does, real estate will be easy to scoop up at discounted prices. Foreclosures will be on the rise. That's going to flood the market. So we're going to talk about market crashes, what you need to be looking for, and how to take advantage of real estate in the next 10 years. By the way, take a second to smash that like button and subscribe. And let's jump right in. Okay, and one of the things that's causing this sort of market crash sentiment is what happened in terms of extreme house prices going up in value during this sort of COVID, post-COVID world. And so I want to talk about that just for a second, because what happened during COVID? I mean, it's crazy. I think we'll probably it's going to have some effect on the market for the next 30 years. But what exactly happened during that time frame in terms of a market rush?
Yeah, I mean, 10 years of appreciation in 3 years is basically what happened.
Yeah. Yeah. And so people are thinking well, that's going to correct. And I think it is in the middle of correcting or something. But basically it's just we saw this rush on property, and that was multifaceted. I mean, you had one of the reasons, local economic reasons, where just people were stuck in their house and they wanted to it's hey, if I'm going to be stuck, let me live in a place that I like, and interest rates are low, so I might as well do that now. So people were generally stuck in their houses. They had nowhere to go. It's like you get to go to restaurants and you're going, okay, well, I'm going to make this as comfortable as I can.
Working from home.
And so people were, buying to get, and that's something we've never seen before, because nobody just moves because they want to. Typically people are moving around a life event. So we saw this flood in the marketplace where people were buying and selling for reasons that we hadn't seen before. In terms of, hey, I can cash out on a ton of equity right now. I can go get my dream home at a low interest rate. The payment's going to be about the same. I'm in good shape.
Yep.
So that was a major thing that was happening during that time. The other thing is that we had sort of economic and political refugees. So basically you had New York, California, Chicago, those folks moving into sort of middle America. And we know in Franklin, we had a ton of people that moved from California to Franklin.
Yeah, most of them, said that they were displeased with how their states maybe handled COVID or things like that, and just accelerated timelines of them moving to different locations within the United States.
Right. And so they were people were striking out and finding a new life. And they're okay, we're just going to I'm not going to do this anymore. And so we found ourselves okay, with this flood. The other thing is California money, they were able to bring tons of cash into the marketplace. I had never seen so much cash going around in the marketplace in terms of over appraisal, over asking price. And so this had an effect on that, you're talking about the appreciation of home values. And so we have never seen that before. We probably will never see it again. But it has an impact. And so I think there are a lot of people that are going, okay, well, is that going to completely fall back down? One of the things that we need to sort of figure out, though, is buyer's market, seller's market, and what causes things to move. What causes, real estate to be a buyer's market or seller's market? What causes things to sell? And really, buyer's market versus seller's market really has to do with inventory.
It's all about inventory. So a balanced market has 5 to 7 months worth of supply.
Right.
And right now we have about 3 months worth of supply in our market.
Right.
So we have a seller's market still.
Yeah, but you could say a lot of people would say, well, what do you mean? Because there's a lot of houses that are sitting in the market. So if it's a seller's market, why is stuff sitting?
If it's overpriced.
Yeah. I mean, I would generally agree. I think that, we definitely have seen a change. But in terms of people who are wanting to buy out there, if you overprice, it's not going to go good.
Well, you've also got this issue with home affordability, right? So
Yeah,
you
that's the
can't
other thing.
err on the side of overpricing because makes homes unaffordable when they're already, unaffordability is already at an all-time high.
Right.
So you can't, it's very price sensitive for that reason, but it still is a seller's market because we don't have enough supply and home builders haven't caught up and will likely not catch up anytime soon.
Mm-hmm.
So to get back to a balanced market, we would need more sellers to come to the marketplace to list homes because they have somewhere that they can go because the interest rates are more palatable.
Yeah.
But we don't have that right now.
I guess my sense of it is like that people are going, okay, well, I can't even afford the house that I'm in right now if I were to refinance at current interest rates.
Right.
And so that's kind of got things a little bit stuck, but that hasn't changed the amount of buyers that are still available to buy properties. I mean, it's not that it's just changed the type of buyer because really during the sort of COVID, post-COVID, we had no first-time home buyers. That was a percentage of the marketplace that usually is in the 30s that dropped down to like 15% just because there was so much cash required.
Right.
And a first-time home buyer is competing with somebody who has cash from California. That's just really not going to go very well. And so you just saw that segment of the market disappear. And now that segment of the market is getting back in. So you still have demand, and we see new construction that sells still pretty quickly.
Yep.
But I guess the thing that I would step back and say overall is that this is really dependent on the local market, like what's going on in your market. Yeah. So it depends because, a lot of the news that comes out, the media that comes out is it's like New York, LA, Chicago, and most of middle America markets do not move like those.
Yeah.
Right. People don't live like that.
But you say houses are sitting, and there are some obviously that are sitting, but think about the homes that are priced right and how quickly they move.
Yeah. I mean, absolutely.
You're still seeing a lot of same day offers, things like that.
But yeah, the other thing though that I would counter that with, and this is not necessarily an argument, there are certain like price segments that don't move as quickly.
Yeah. But I mean, I think again, like when people that could normally afford a $2 million home because interest rates were what they were, maybe can't now. Mm-hmm. So it shifts everything around.
So you would say we're still in a seller's market just because of the amount.
No question.
We don't have enough inventory for the amount.
Yeah.
Right. And so the buyers basically switching to a buyer's market would be driven by the supply going up.
Yeah. I mean, you would have, you wouldn't have same day offers and things like that.
Right.
If it weren't.
That's a really good point. I mean, we still are dealing with multiple.
Now, there's still
properties.
nuances to every market, and there are still homes that are sitting. There are still, situations in which you're getting multiple offers. Mm-hmm. So I would say there's nuances to the market, but yes, statistically speaking, we're still in a seller's market.
Yeah. I want to take a second and talk about Hessen Loans. I'm wearing a really cool hat from Hessen Loans right now. What can you tell us about what market rates are doing right now and how to get in touch with you?
Well, we had a dip back the week of the 10th and 11th of July, so that was great. It's great to see that relief back below 7, so that's always a positive. And hopefully, as we progress through the rest of 2024, we see, a slight decline in interest rates, hopefully towards mid to low 6s. But more importantly, I would say, if you're working with a mortgage professional, make sure it's a broker. Doesn't have to be Hessen Loans. Any broker will do. But what a broker does is work for you. They don't work for a bank. Think about it like if you were going shopping, right? And you had an item that you wanted to buy. Which would be your preference? Would you want to go just buy an item off the shelf at any old store, or would you ever have a personal shopper that went out and found the best price for that item and then brought it back to you and delivered it to your doorstep?
Yeah.
I would want the latter. And that's what a broker does. They shop your file out to any number of given lenders at any given moment, and they bring you back the best possible situation for you, not for the bank. And that's the way I'd want my mortgage done.
Okay. All right. So what causes market crashes? And so we wanted to go back over a couple of different market crashes. The last couple that we had. The last one would be 2008, which is when I got my real estate license. And what caused that? And so I watched this movie, The Big Short, which you probably have watched. I love that movie. But it talks about, basically they were qualifying everybody back then, first of all. So your restrictions on qualifying for a mortgage were a lot less. It felt like they were kind of phoning in appraisals at the time. And then you also had adjustable rate mortgages, which were a huge like player in the market. And so when those rates adjusted, then people couldn't afford the payment anymore.
Yep.
And so you had sort of like a perfect storm of defaults to cause the market to completely shift, and then foreclosures kind of like flooded the market more in some areas than others. You know, you saw a big dip in values in California, in New York. And so there was a whole situation there that was happening. And that would be a true market crash.
Yeah. I mean, there was a lot of 0% loans too. So people didn't have equity built up. So if prices adjusted down, you were upside down.
You're upside down.
Most of the time people don't realize could happen in a home. You know, they think that's just like a car situation, right? Where you buy it with a really low down payment, you drive off the lot, it dips, and then there you are. But that was happening with home situations as well in 2008. And that's the difference between then and now.
Yeah.
So now people have a lot more equity in their homes, statistically speaking. And so the risk of something like that, because the lending restrictions are so much tighter and stricter, that's so much less likely to happen.
Yeah. So that's probably not going to happen like that. You know, the other thing is like another sort of really difficult housing market would have been like in the 1980s when interest rates were sky high. However, you also had lower house prices. And so it wasn't as...
Yeah.
I mean, our house prices are pretty high.
So the reason why it's more unaffordable now than it was when you saw interest rates at like 18, 19, 20% is because the home price relative to your income.
Yeah.
So now home prices are 5, 6, 7, 8x your income. Whereas before, it might have been 1x or 2x. Mm-hmm. And so, you know, you might be making $80,000 and buy a $100,000 house. And it was at 20%, but it's still, the unaffordability wasn't, the gap wasn't as large. But now, you know, people are making $100,000 buying $600,000, $700,000 houses.
Right.
And so tack that on with 7% interest rates, and it gets really unaffordable really fast.
Yeah, exactly. And so we find ourselves in this, like, from an affordability perspective where interest rates are so high, it just makes it difficult to move in the market.
But think about it across the board too. Like people were buying $10,000 cars. Well, now they're buying $100,000 cars. I mean,
that's crazy.
Like an SUV now is like 80, 90,000.
It's crazy.
You know, it's not just homes, it's everything, but yeah.
Yeah. What do you attribute that to generally? Because I mean, I don't feel like salaries have gone up reflective to
how much
things are.
Yeah, that's right.
So I mean, it's worth considering, but you know, does all of that really lead to a housing crash? We'll continue to talk about that. So here's where we are right now. Okay, we have sustained interest rates. They don't seem to be moving a ton. They're moving a little bit. Okay, we've got the affordability issue. We have I would say house prices are steady or softening in terms of what sellers are willing to offer. So sellers right now, we haven't seen like a total dip in house prices. Sellers are offering concessions. We didn't see any concessions during sort of COVID, post-COVID market. And who's buying right now? And so we've seen a shift in who's buying houses. So where we had sort of that middle ground of people buying houses that were buying their second, third home, you know, moving up in houses, that sort of buying group seems to be pretty static. The people who we see buying houses right now are first-time home buyers, investors, relocations, and then grandparents moving to be close to grandkids. That would make up the majority of our, you know, sales in our brokerage over the past 12 to 18 months. And then we also sort of have like election year. And do you feel like election year affects the housing market?
I think it affects consumer sentiment and can affect the housing market. But actually, a lot of statistics show that mortgage rates don't move as much as people think they do in an election year. So, but yeah, it can affect consumer sentiment for sure, especially if your candidate wins or loses and how you feel like you should spend your money from there on out. So I do feel like it does have an impact.
Yeah.
On consumer spending as a whole, not
no question. So, okay, so the final question then, what will happen? Will there be a crash? And so we need to talk about, inflation and jobs and all that stuff and interest rates. And we talked a little bit about this last week, but in terms of like where interest rates are, and it doesn't feel like, again, it's like we start at the beginning of the year and they go, hey, we're going to drop interest rates. And it doesn't feel like they have. And so we're trying to figure out like, okay, when is this thing going to drop? Because my feeling is like when interest rates drop, that's going to cause a flood in the marketplace.
Yeah. Unless you diverge from basic economics, like economics 101, then a market crash is very unlikely. Mm-hmm. And the reason speaking is there's still a lot of demand for homes.
Yep.
Still short in supply. So high demand, short supply. Mm-hmm. I mean, in May, we were still up 6% year over year price wise for homes. So, I think it's very stable. And unless we had a, kind of just a flood of inventory, the economics don't make any sense. And I think the opposite is true. If rates come down, you're not going to you might have a flood of people listing, but you're also going to have a flood of people buying. Right. So like, it just doesn't support the market crash, so to speak. Now, I do think it's softened. Sure. I think we've seen a softening, and mainly because people still haven't nailed the pricing the way they should. So like, I still think that prices homes that are priced appropriately are selling fast. I think the ones that aren't, sit. But I think, so that is creating a little bit of softening, but I don't see the economics around a crash.
The other thing that I think about is like what a market crash means for, even if there were to be a market crash. Like, and I lived in Oklahoma during the last one. We didn't really see house prices like bottom out.
No.
Right. Like California, like, oh, I lost like $500,000. Like there wasn't $500,000 to give on a home in Oklahoma. Because it's a $200,000 house, it's not going to zero. It's not going to negative. So you saw like a little bit of variation in pricing, or maybe some give in terms of closing costs. But I didn't see like just massive swings like you were going to see in East Coast and West Coast. Yeah. And I think that's largely the same. Even if we are to see a market shift in that way, you're not going to see like people losing, hundreds of thousands of dollars in houses in most of America.
No. And honestly, I mean, even the quarter point drop in rates that we saw over the last like month, that created a 400% increase in applications. That just shows you that people are like, I need to buy, but I can't. And
there's pent up demand.
Yeah.
Right?
So like it's, those things come down to low sixes, high fives, something like that. Mm-hmm. I just think the floodgates open.
Yeah. So I guess from there, so neither of us really believes that there's going to be a market crash. Sustained, if we don't get these interest rates to move down, we're going to be kind of, I think, stagnant for a little while. That doesn't mean houses aren't going to sell. So I'm just saying the market that we're in right now in terms of who's buying is going to stay the same. But what I would tell anybody right now is like, okay, well, if you're a home buyer, especially a first-time home buyer, I would say, hey, go ahead and buy now and because it's going to be less cash to get into a house now. Refinance when the rates come down, and then get the equity bump of being of the market shift, right? Because when the market shifts back, you're going to gain equity. Your house is going to go up in value.
Yeah. There's still homes that get listed day one that don't offer seller concessions and get sold with multiple offers. So those would be maybe ones to avoid. But like if a home's sitting and you like it, you're going to get seller concessions. And I don't believe you get those if interest rates go down.
Yeah.
Because I think you'll have more buyers out there that are ready to pull the trigger.
Yeah. And what I would tell sellers is like, hey, look, you haven't lost, quote unquote, equity in your home. You've gained a bunch over the past couple of years. So if you need to sell for whatever reason, it's not a bad time to sell. Obviously, you may not have as many multiple offers as we would have had 2 or 3 years ago, but you can still cash in on a ton of equity on your house. So it's like, well, look, if you can stay there for a long time and you want to stay there for a long time, that's fine. But if you need to move for whatever reason, that you shouldn't hesitate.
You shouldn't, because I mean, whatever you're experiencing on the sell side, you're going to experience the flip on the buy side. So right. Yeah, you might have to give up a little bit of concessions if your home's sitting, probably mispriced. But if your home's sitting, you might have to give a little concessions. But guess what? You're going to get them on the buy side. So now's still a great time. If you wait and you get multiple offers on the sell side, well, guess what? You're going to be experiencing that on the buy side.
That's right.
So it's always a good time to buy or sell if you need to.
Yeah.
There's always going to be, it's always going to work itself out. And that's what I would say. And guess what? You have, like you just said, you've gotten a ton of appreciation in the past 4 years.
Yeah. And if you're an agent, you need to be talking about this with your local economy, right? With the people that you have influence over. Sharing, it's like, hey, look, there's a lot of stuff that goes on in the media. There's a lot of stuff that's sort of like just sort of talk out there in the world, and it's not necessarily representative of reality.
Yeah.
And so you can control the narrative. Well, not control, but you can affect the narrative by what you share in your local economy with the people that you have influence over. So continue to, preach the good news. It's like, like over any 10-year period, housing values are going to go up. And so waiting or trying to time the market is never really a good strategy. But I think, buying or selling a house now is fine.
Yeah. I mean, really great appreciation is 6% a year. And, there's homes in Franklin that have done 120% in 4 years.
Yeah. It's crazy.
It's crazy.
Yeah. So, all right, guys. Well, any final words?
Nope.
Guys, thank you so much for joining us. Make sure to like, subscribe, and we'll continue bringing you guys weekly updates. Thanks so much. We'll talk to you soon. Bye.
Bye.